Hello, good afternoon, everybody. I would like to welcome all of you on our IBOR reform webinar focusing on how the changes impacting internal data workflows and what companies need to do to prepare for it. We have a variety in our audience today. We have received registrations over 24 countries, so I hope we have a very interesting discussion today. Please allow me to introduce myself. I'm Vera Kocic, the Sales Director for Enterprise Data Feeds for Middle East and Africa, CECIS. I'm sure all of you have been in touch already with my team across in your region, talking about our data feed solutions as real-time feed or end-of-the-day pricing and reference data feed. Today, I have two colleagues with me. Vince Di Mase, Global Sales Strategy and Execution Director for Trading, and Jacob Brank-Broadley, Head of IBOR Transition. Together, we'll help you to navigate in the labyrinth of the IBOR reforms, what has happened, where we are, how the benchmarks related to former LIBOR markets, and what you need to consider for your application's data processes. Before we jump into the subject, a bit of a housekeeping. We are looking forward to answering all your questions, and we allocated for that time the end of the webinar. But please keep submitting your questions throughout it, and we are going to answer them at the end. We are also going to launch some polls during the presentation to capture your thoughts and views on your discussions. You also find for that at the bottom of the toolbar, your screen, the menu point. And with that, I would like to invite Vince to introduce us the major changes, differences between the LIBOR and the new risk-free rate world.
Yeah, thanks, Vera. Thanks a lot. And good morning, good afternoon, everyone. And thanks for having me today to comment on one of the most challenging projects the financial industry had to go through, and it's still going through, the LIBOR transition. After almost 2 months and a half in 2022 and following the first main deadline met with the end of 2021 and the cessation of most LIBOR tenors, it's good to draw a line, as you said, Vera, and then look at what has been achieved so far. Well, the new rates are being adopted, have been adopted. What are the next key milestones for this project, for this year and the following year, and what are the tools to navigate through this transition? Indeed, the LIBOR transition is not over, that's for sure. And we are moving clearly from specific LIBOR transition into a wider concept of IBOR's reform, with more rates being involved. Similarly, when the LIBOR transition project kicked off several years ago, we all knew the set of financial but also non-financial risks embedded in the adoption of those new rates, from operational to technology to reputational, but also contractual challenges to deal with. So it's good to analyze where we stand in the project, in this journey, through the lenses of those variables as well. From a pure technology infrastructure point of view, I would say new rates had to be sourced and digested from core banking systems, treasury, risk management tools. And in the LIBOR environment, I would say that the framework was pretty clear. We used to have one administrator to deal with one rate available for 5 currencies and a total of 35 tenors. Now, the move into alternative reference rates radically changed this to some extent. And we entered a new multi-rate environment with multiple rates, multiple administrators to deal with, and different rules, if you want, even for permissioning and for the fees associated to some of those to access those rates. For sure, all those rates had and have one element in common. Those are all based on transactional data, so derived from real transactions. A full new construct, as we all know, compared to the one of LIBOR, which showed its vulnerabilities and exposure to manipulation via the panel bank contribution system and the lack of adherence that it went through in terms of adherence to the real conditions of the market. At the same time, as we all know, all rates now are overnight, which determine the need to solve, for term structures. And similarly, I would say, as it's very, I think it's common knowledge, all of these are risk-free or nearly risk-free rates, as they do not incorporate elements of credit, counterparty risk, and also opening a nice debate we went through in 2021 in the industry between risk-free rates and those rates incorporating that credit sensitiveness. With those last ones receiving definitely not a positive comment from key authorities, but whose adoption is interesting to monitor for the future. Now, despite all of those changes and new framework, we met the end of December 2021 deadline. So the first effects of the change are clearly visible. And I thought the best way to recap what happened was to display the snapshot. It took a few days ago, so don't look at the rates and the dates. But this snapshot of the current, or if you want, old LIBOR page, exactly summarize what happened and what is going to happen to some extent. As you can see, out of the 35 tenors, we just have rates displayed for US dollar for some tenors only. So the spot week and 2 months are not there. But at the same time, we also have rates for GBP, for sterling, and Japanese yen. But actually, those are not, and we will comment this in a second, those are not coming from the old LIBOR construct, but they're coming from the new synthetic LIBOR concept, which we will discover in a second with a little bit more of detail. But this is what happened. So a new framework of rates, which became not available for the majority with the end of the year. And indeed, if we look at the timeline and a quick view on the timeline, definitely, we mentioned before, this project started several years ago, but definitely the acceleration was last year. With the 5th of March, the announcement from the FCA to the cessation of, or the non-representativeness of all of the 35 LIBORs, things accelerated. So the motion was really accelerated, also ignited and speeded up by the so-called RFR first initiatives. And here you have some mentioned, the ESTA first, the SOFR first, obviously the SONIA first, which introduced a change, a switch into the conventions, and so forced the market to move into the full adoption of risk-free rates. We met the first deadline, as we said. Now, the next important one is obviously end of June 2023, where we expect to see the end of application for the missing USD LIBOR ones. So the overnight, the 1, 3, 6, and 12 months, which will indeed be another important milestone. But 2021 gave us also another important tool. Indeed, September 2021, the FCA published a consultation paper on synthetic LIBOR for GBP and Japanese yen, which actually came to life on the 4th of January, when IBA, compelled by the FCA, started publishing the synthetic LIBORs for sterling and for Japanese yen. So this is in a nutshell what we can expect. And obviously a representation of the fact that the LIBOR transition is not over. There are still important deadlines and milestones, including, and most importantly, the 30th of June 2023. But also, as you will see in a second, the future of the synthetic LIBORs will be an very interesting topic to monitor in 2022. If we focus now and we deep dive a little bit on the synthetic LIBOR initiative from the FCA, definitely we need to mention that the so-called synthetic LIBOR rates were introduced to avoid market disruptions and to support the market in the transitioning of those contracts who can be defined as staff legacy. So those contracts which cannot be transitioned into the new alternative reference rate in time with the end of 2021 deadline. Think about the bond whose consent solicitation process is long and expensive enough not to met the December 2021 deadline, and the complexities of some financial products and contracts which make it difficult to proactively migrate and adopt a new rate or introduce wording that can let them survive, basically, and adopt a new rate. As a matter of fact, the synthetic rates are available, and it's important to note that since 4th of January, those are there for the 1, 3, and 6 months, only for selling and Japanese yen, and can only be used for TAF legacy. So back to the point of the reason why those were introduced, right? It's to support the market in that orderly transition for those TAF legacy contracts. So it's not a, if you want, an extension of the project or a delay of the project. It's just about those rates being available for a limited time frame. So we can expect until the end of 2022, as you can see in this slide. And this does not, let's say, avoid the proactive and active transitioning of those contracts, which needs to be completed, because at some point those synthetic rates will stop being published, and so we need to migrate. The market needs to migrate those rates. The final comment I will make on the synthetic LIBOR is that obviously the construct, the methodology of the synthetic LIBOR rates published by IBA is different from the one of LIBOR. So we're talking here about an equivalent to LIBOR, but which is calculated adding up an ISDA median spread to a term rate. So it's completely different mechanism compared to the contribution mechanism of panel banks that was used and still used to some extent for LIBOR rates. The key thing, as you have seen in the previous snapshot, we continue to publish those synthetic rates using the same codes available for consumption of human eyes through our desktop, but also through for machines, so via our feeds. And those are obviously available via Refinitiv platform. One other element that I mentioned before was to judge after 2 months and a half, where do we stand when it comes to adoption, when it comes to volumes done on risk-free rates. And this slide is a collection of few charts just to outline the growing and linear growth trend when it comes to volumes on linear swaps, starting from top left, but also syndicated lending, cross-currency swaps, where we saw a huge amount of risk-free rate versus risk-free rates, cross-currency swap, mainly SOFR ester ones, and also swaptions volume. So you see the role of SOFR is growing, so market is adopted increasingly, and it's obviously a good thing to note, right? After all the preparation done, especially during 2021, during the last months of 2021, and with the beginning of 2022. If we move from instruments to currencies and jurisdictions, and if we look at adoption of risk-free rates in swaps trading, and starting from top left, right? And if we look at the bar on those slides, and comparing the yellow versus the orange red, you can see that SOFR counts for almost 30% now compared to USD LIBOR, is growing and has been growing since, let's say, the SOFR First initiative towards the end of 2021. If you move down, you see ester still. This is January data. There is a little bit more for February, but around 14-15% ester versus Euribor. But bear in mind, Euribor is strong, solid, robust benchmark, and so it's still there and it's still used. But then if you move to the right section of this slide, you will notice it's all yellow. So the process it can be considered completed when it comes to SONIA, so to GBP, TONA, so Japan, and SARON in Switzerland. Actually, as a quick note, the working group, the CHF, the Swiss franc working group on risk-free rates, will terminate its operations by the end of this quarter. So to give you a sense of the progress they made and in terms of adoption of SARA and transition into alternative reference rates. Very quickly, one of my last slides. As I mentioned before, the LIBOR transition is now progressing, well progressing, I would say, but is also opening the door to IBOR reforms, the wider one. And one option to look at this change and this new motion, expected motion, is to look at the ISDA fallback rates, which originally covered some specific currency pairs, the one of the USD LIBOR previous construct. But now they announced in December 2021 the publishing of a new set of fallback derivatives reference to some of the IBORs not covered before. So we will have, and those will be available and are available by our platform for India, Malaysia, New Zealand, Philippines, but also Norway and Sweden with NIBOR and STIBOR. And so you can see how there is a change going on. There are more jurisdictions, currencies being impacted by the change. Some directly with a new rate replacing the previous one, and some others changing because the previous rate was linked basically to USD LIBOR as an example. So definitely the initial statement of the LIBOR transition is not over, is valid, and is moving into a wider IBOR reform motion and projects to be handled, related obviously to the exposures you may have. In this environment of multi-rate framework, one thing we opted for was to consolidate some of the information in one view in the IBOR app, which is available via Icon Workspace, and gives you a quick overview of all the main incumbent and successor rates, the new alternative reference rate, with the opportunity to deep dive on single currencies and also to navigate across the main ones, right? So going through sulfur, ester, SONIA, TONA, and also the key benchmarks we are introducing. Here you see mentioned, obviously, the USD IBOR cash fallbacks in the orange box, but definitely the role we play as a company in assisting the market and supporting the market as a trusted advisor within this journey is also to provide tools, right, including benchmarks and rates that can be used actively from the market. And with that idea in mind, I would like to now hand over to my friend and colleague Jacob to cover exactly those elements and how benchmarks play a role and what is the role Refinitiv plays there. Jacob, back to you.
Thanks, Vince, and good morning, good afternoon, good evening, everyone. As Vince said, I'll take a little bit of a deep dive into benchmarks and take a look at how we're moving from a single rate environment to a multi-rate environment. But before we kick off, maybe a quick question to make sure that people are fully engaged and not too distracted. So just an opportunity to get a bit of debate going and get a bit of feedback. So question to you, the audience: to what extent have you adopted new LIBOR replacement benchmarks? The objective here is really to understand how far through that process you are. So at the most extreme end, I don't use LIBOR anymore, including synthetic LIBOR, and I've sourced all of my RFR replacement rates, my fallbacks, and my term rates. So I'm fully adopted onto an RFR type environment. Second option, I have limited use of LIBOR, and I've sourced some of my replacement benchmarks. So for example, in some places you may still be using US dollar LIBOR, which is still around until the middle of next year. Option number 3 is I've sourced limited amounts of benchmark data to replace LIBOR, so I'm very much dependent on either LIBOR or synthetic LIBOR, haven't fully embraced the change yet. And the final option is I've sourced no benchmark data to replace LIBOR, which probably puts you in a little bit of a tricky situation since the beginning of the year. So we'll just give everyone a few seconds to respond to that. I really hope we're going to see responses towards the top of these questions. Really hoping everyone's had an opportunity to engage in this topic before, think through the process and adopt as much as possible under new interest rates that are available. So if we just switch over to slides, give everyone another few seconds. really encourage people to engage in the question and see how they're doing. Okay, so if we take a look at the responses. Okay, so we have no one's got off LIBOR at all. That was definitely a big ask to do that. We've got 15% of people who have adopted replacement benchmarks to some degrees. We've got the majority, more than 80%, who have either sourced limited data or have not sourced an alternative at all. So hopefully this session can be really useful, help get you up to speed in some of the topics that we'll discuss. So first things first, it's really important to understand that with the LIBOR transition, it's not about going from LIBOR to a single replacement rate. That's probably the most difficult point and the most fundamental element of the switch to take into account. The advantage of LIBOR is you had one single regulator, you had one benchmark administrator, and you had 35 settings, which made life relatively straightforward. It was quite easy to work out what the right benchmark was. It very much depended on your currency and then what tenor you wanted. Life's becoming a little bit more complicated now, and there's no longer a single benchmark that replaced LIBOR. First thing to note is the fact that we have different benchmarks for each of the 5 LIBOR currencies. So you heard people talking about SOFR in the US, SONIA in the UK, ESTA in Europe, TONA in Japan, and SARON in Switzerland. The second point to take into account is that it very much depends on the type of product that you're trading or using will determine what the right benchmark is. And you also hear lots of different types of benchmark. And yes, there are different types of benchmark, but there's a consistent framework that weaves all these together. So actually, it's not that complicated, but it is definitely more complicated than we had with LIBOR. So the first distinction that you need to make is understanding whether you have a legacy product. So this is a derivative or a bond or a loan that was issued before the LIBOR cessation, or whether you're talking about a new product that you're about to issue. And those will determine which benchmarks you need. So if you've got a legacy product, you may be interested in either synthetic LIBOR or a fallback. Now, as Vince talked about in synthetic LIBOR, this is essentially a catch-all. You've already got your contract out there. You haven't had any ability to put in place fallback language. You haven't had the ability to switch. And you just need to make sure that come the beginning of this year, for most currencies, or for US dollar come the middle of next year, you don't want to be in a scenario where ultimately that contract just ceases to function. You're going to end up with a lot of disputes. You're going to end up with courts being clogged up in that case. So this is your absolutely last safety net. In the derivatives market, the vast majority of participants have signed up to the ISDA protocol, and this acts as a safety net for OTC unclear derivatives. And essentially what they've done is they've taken this RFR concept and they said, right, well, the best way of using that is to take a look at that average rate that we experienced over the same tenor in the past, which is different from what we've got LIBOR, which gives you a tenor for the future. And that's compounded in arrears. And then you need to add the average difference between LIBOR and the RFR to compensate for the fact that the RFR is actually risk-free. So there's no credit risk, there's no liquidity risk premium associated with it. So typically the RFR will be lower than you'll find in the equivalent version of LIBOR. So that's based on the long-term average difference over the previous 5 years. Now, in some markets, we also have fallbacks for cash products, specifically the US. And so between those 3 benchmarks, that should cover you for all of your existing contracts which are out there. So we've already got from 1 benchmark to 3 benchmarks. Now we've got to think about new contracts that you might want to sign. So historically, you might want to adopt a new US dollar LIBOR referencing loan or US dollar LIBOR referencing derivative. Well, in that case, you're not going to be able to do it anymore for the way the rules are set up. And so you'll need to think about adopting the RFR. And those RFRs have many different conventions, but generally speaking, the adoption in new derivatives is to use compound in arrears, and then there'll be some sort of lockout or look back to give you a little bit of time just before the end of that period in order to do your calculations and make sure you can work out what the right, for example, coupon payment or interest payment would be. Now, these are great in terms of if you're got very sophisticated setups, you can deal with that switch from being forward-looking like LIBOR to backward-looking in terms of RFR, adds robustness to the benchmark and its confidence. But not all systems can support that, and it's not always appropriate to have backward-looking rates. And so this is where term rates come in. So term rates look and feel much more similar to LIBOR, but with a key difference from an operational perspective that the term rate is no longer, so the term rate is risk-free, whereas LIBOR is not risk-free. So we've got that adjustment from that credit risk component. And so here, the regulators really sort of say, well, we don't want to have too much usage of these term rates because you end up with a scenario like LIBOR. We end up with a very big usage based on a very small number of contracts we're actually trading. And that can end up with an unstable benchmark environment. But in some circumstances, if we don't let that get too big, those term rates can be really useful because that forward-looking component has been a key element of what we're used to in interest rate benchmarks and ensure that the majority of derivatives activity remains on RFR's compound in arrears, and then ensures we have the best of both worlds. We have a stable benchmark, but also where it's appropriate, we have that forward-looking element. Now, it's important to note that whilst we've now got these 5 different categories of benchmarks that can replace LIBOR, life becomes even more complicated because the use of those 5 different categories isn't necessarily identical across each of the LIBOR currencies. Different currencies have adopted these concepts in a broadly similar but not identical way. The final point I just want to highlight on this slide is that it's not just LIBOR replacement benchmarks that are impacted by the LIBOR reform. You also have things like impacts on swap rates, not to mention all the derived data and process data and everything downstream which your systems are based on. So in the case of a swap rate, the swap rate will measure the fixed leg of a vanilla interest rate swap, and in many cases that reference LIBOR. And so now if you have a swap rate which would have a tenor from 1 year onwards, you now need to think about then replacing that swap rate benchmark. And so if we take, for example, the Japanese market, Refinitiv as minister's benchmark or Tokyo swap rate, that entire benchmark family has been reformed in order to adapt to this new environment. So let's go into a little bit more detail. If we just take a look at the GBP market. So in the GBP market, SONIA was selected as a replacement for GBP LIBOR. And so this gives us a reformed overnight risk-free rate, which thankfully was adopted relatively early. It was an existing benchmark which was already widely used, and that's really supported the IBOR transition in the GBP market and made it a much smoother process than it could have been otherwise. If we then apply that to the derivatives markets, the SONIA rate is, as we talked about, compound in arrears. We add the 5-year median difference between GBP LIBOR and SONIA, and then we use that to essentially get something which is an approximation of what GBP LIBOR should be, and that's the convention used in the derivatives market. As Vincent explained earlier, in January saw the introduction of GBP synthetic LIBOR, which could in theory be around for up to 10 years, although is reviewed annually, so may potentially go away at the end of this year, depending on how widely it's used. It's limited, so whilst it's really tempting just to carry on using LIBOR, it's really important this is only for legacy contracts, so nothing new should be used against it. And it's not even for all legacy contracts. If you've got a clear derivative, the clearinghouse should have updated the rules and therefore no longer be using those. So it's really targeted just towards some segments of the legacy market. And the way this is calculated is to try and be as similar as possible to the LIBOR itself. And the way they do that is they get the term SONIA benchmark, which measures your risk-free forward-looking component, and it's added to a fixed spread adjustment, which is going to measure the credit component. Except the key difference here is on LIBOR, that credit component changes from day to day, depending on the credit risk available in the market. With synthetic LIBOR, that's fixed. That basically takes the average long-term credit component of LIBOR and sets that as a static number. Now, from Refinitiv's perspective, we're trying to support the IBOR transition market through the introduction of term SONIA. So in January 2021, we introduced a Refinitiv term SONIA benchmark. And so as I talked about, this measures the risk-free forward-looking rate. It's available in tenors from 1 month up to 1 year. and the rate's actually become very widely adopted in the industry over the course of the past 14 months or so. And what this has allowed the industry to do is say where really needed a term rate. It's really important to understand that the UK has been really very focused on making sure that term rates aren't excessively used. We don't want to end up in a scenario where we've got LIBOR with a small number of transactions responsible for a benchmark, which has become really widely used. And so thanks to the working group and the industry standards around it, it's really been targeted towards the trade finance market, where it's important to have that forward-looking component, and some segments of the loan market, as well as products such as Islamic finance. Now, if we move on to the US dollar market, again, a lot of the concepts and structures here are very, very similar to what you see in the GBP market. But because this has been done by the ARC, which is a US body responsible for IBOR transition, unlike the working group in the UK, they've taken slightly different interpretations of the same structure. And so firstly, we have this concept of fallback rates for cash products, which doesn't exist in the GBP market. So in the GBP market, it's assumed that if you've got a cash product that you can't transition, you're going to end up falling back to synthetic LIBOR. Now in the US dollar market, they've taken a slightly different approach. What they said is, well, if you've got a US dollar referencing contract and it has no fallback language, all that fallback language references US dollar LIBOR, then ultimately you need to solve that situation. You're going to end up with a lot of disputes. And so they've introduced legislation that then essentially eliminates that fallback language and replaces it with the ARC's recommended fallback language. And that is essentially something quite similar to what we saw with synthetic LIBOR, where there's a SOFR component and then a spread adjustment. And so in March 2021, the ARC selected Refinitiv to publish these rates. And so these rates, as I said, are composed of SOFR plus a spread adjustment, and you can get different versions of it. So at the moment, there's SOFR compound arrears, SOFR compound advanced, and simple SOFR. And we're also looking to introduce a term SOFR-based version as well. And then there's a version which is for consumer products, such as student loans and mortgages, where that spread adjustment is gradually introduced over a one-year transition period. And we've got institutional products where there's no transition period, and those spread adjustments get added at the point where the relevant tenor ceases. So for 1 week and 2 month US dollar LIBOR, that was at the beginning of this year. And for the other tenors, that's in the middle of 2023. It's also worth talking about term SOFR here. And so here, term SOFR is available and akin to a term SONIA in the GBP market. But it's really important to think about the use cases. So in the GBP market, the regulators were very concerned about having excessive use. And that concern is shared with the US market, but the US market has taken a slightly wider view of what's acceptable. And so you'll see slightly greater use of a term SOFR benchmark in cash products, which is really where it's targeted towards. And then also, such as with term SONIA, very limited use in the derivatives market, really only designed to hedge where you've got a cash product that you really, really need to use that. And then the final component is the synthetic LIBOR. And there are big question marks whether we will or won't have a synthetic LIBOR. Hasn't been confirmed yet for US dollar. But the good news here is there is time. And also we do have the fallbacks to the cash market. Potentially some of the requirements for a synthetic version of US dollar LIBOR may not be in such high demand. And so the final currency I just wanted to do a deep dive on was the euro market. And the euro market, again, is quite interesting because it's very different from the other currencies that we've got with the LIBOR transition. So in US dollar and GBP LIBOR, which we just talked about, LIBOR is a key interest rate benchmark in those markets. Now for the euro market, Euribor is the primary interest rate benchmark, not Euro LIBOR. And so it creates a very different dynamic because Euribor has not been subject to a cessation date yet. And so the materiality of the LIBOR transition in the euro market is much less than it is for some of the other currencies. And for that reason, we don't have a synthetic euro LIBOR benchmark. It wasn't introduced if people had a product and it needed term rates which behaved very similarly to what we had for euro LIBOR. Euribor is very well adopted and established benchmark. We also don't yet have a forward-looking version of an ESTR benchmark, a term ESTR, so to speak. And this really comes down to the fact that the market hasn't been developed. So if you remember Vince's slide back at the beginning, he showed Sonia, Saron, and Tona fully adopting the RFRs in the linear derivatives market, but we saw much, much less adoption, around 15% in the euro market. And that lack of activity in the derivatives market really then feeds through. If you don't have activity in the derivatives market, you can't build a term estimate benchmark because you don't have the rates in order to produce it. And so we don't have a term estimate benchmark. But I think it's really important to say that there are plans for a term estimate benchmark. The working group, the Euro working group, has defined the use cases for a term estimate benchmark, acting as a fallback for your IBOR. And there is an intention for a term estimate benchmark to become available as soon as liquidity permits. So hopefully that's been a good introduction to some of the key changes we've got in the interest rate environment coming up. So I'll hand over to Vera.
Thanks very much, Jacob. So thanks very much, all of you. I also have a fun question for you, just again, to start the discussion a little bit and step into the area of data flow and applications. So let's just take for a minute. Is your application ready to handle the new risk-free rate data sets? Yes, you already did all the work. Not yet, but you are well planned ahead, or we are still looking into it. So please share your views. And I also would like to encourage everybody. We already received a couple of very interesting questions that please post your questions in the chat. We would be very happy to answer as much as we can. Just one more second. We have almost everybody answered. Yeah, we are getting there. We are getting there. Okay, let's see where we are with the answers. Very interesting, definitely. And I think it really shows, as we started, that indeed we are, March 15th, well in the year, but there's still the IBOR reform topic is one of the most challenging for the entire industry globally. So I hope that in the next moments as well, we can help you to navigate in that area and to identify what actually you need to do and what you need to think of when it comes to your data flow and when it comes to your applications. As Vince, Jacob, both of them, came with a very long list of definitions, what happened, what are the things to consider, how Refinitiv and how our solutions can help you in that process to make data available for you in a format which is very easy to consume for your front, for mid, and for back office application as well. So we have listed a couple of points when you are looking at. So one of the problem when you have a perfect data flow, when you have an application when it's sitting and working every day, then you even don't forget where the data is coming from, where is it sitting, and untangle all that can be a very big challenge. And additional to that, as Jacob just introduced it to us, it's not just one set of rate which I need to change and here and there I need to adjust my system, but we were introduced a very long list of new instruments, a very long list of new definitions, and not everything is working how it used to. Vince talked about it, that the LIBOR rates were forward-looking. Now we have a system which is backward-looking. That LIBOR was including credit risk, risk-free rates are not. Jacob walked us through when the fallback rates can be considered, when the compounded rates should be there, and when you should consider using the term rates. So loads of many definitions, loads of different points to go through and to see how they are impacting your derivative trading, how they are impacting your cash instruments, and so on. And that is the big challenge, that how to untangle actually a perfectly working system you have, how to find those areas where the data is sitting. So what else to consider and where we can help is going through the different data points, what you need, how they are, and where we can develop and help you with that. Our different products like Datascope Select, which you may know, or our real-time products can help you to deliver all the different fallback rates, compound rates, term rates, risk-free rates, which we just got you introduced. They can help you to automatically integrate into your system and flawlessly getting updated as we speak. Please refer to your account team to get hold of our LIBOR key dataset summary file. We have invested lots of energy and time to summarize all key definitions for you, summarize all the relevant risks for you, and also highlighted that which are the sources and what are the different commercials for you. Because what is the challenges, and I'm surprised Vince didn't use the metaphor which he used at many different presentations, that the whole LIBOR transition is like a ship which was turning very, very slowly, but when you started the turn, then you cannot stop it. And here we are not talking about one ship, but several ships, because as he mentioned, till now, we had a very simple system. As bank manager administrator was owning and calculating the number, or administrating LIBOR, and going forward, you need to deal with different jurisdictions. You need to deal with different data owners for the risk-free rates, different data owners for the term rates, different data owner for the fallback rates, and it really creates a very big maze of new contacts, new commercials or data sources to configure. And our LIBOR key data set summary file can really help you, and our account team is there for you to support you in that conversation. There is one thing what we didn't mention also when it comes to cash instruments, that LIBOR fallback language can be a very important for you. It's available on our desktop product, but more importantly, again, you can introduce into your workflow via our Datascope Select product reference data sets. The new fields have been added to the product to capture the information which describes the impact of the coupon event in case of a LIBOR is not available. And also all information which is going through, we are going to publish step by step in our Datascope Select product line. So we went through lots of different data sets. We went through lots of different definitions. So a bit of summary that what actually all the content and analytics Refinitiv created for their customers to support the whole transition process. We have all the risk-free rates available via our products. We have launched Refinitiv Term Sonia, which is now almost a year old. So, and we captured all the market feedback to make sure that it's the best reflecting the market participant view, and actually it's representing the market. We have all necessarily fallback language and reference data available for you to manage the transition from IBOR to the new risk-free rates calculations. We have carrying all the fallback rates from ISDA or from ARC recommended Refinitiv US dollar IBOR cash fallback rates via our solutions. And we also provided the necessarily calculators in our desktop product, so your front office colleagues can do the daily adjustment in their workflow. But later on in the presentation, I will also would like to introduce you a solution how can adjust for you and help you to compound your own forward-looking rates from the backward-looking reference rates and valuation tool. But just before that, one of the challenge of the whole migration as well, that product which was before very known and available, interest rate derivatives, IRS, OIS basis swappers, suddenly are not there because they need a new basis for that. They need a new basis for which cannot be relying on a LIBOR. And at the moment, the most reliable source for that is actually coming from the interdealer brokers. Via our products, Icon, Datascope, and our real-time product as well, we are carrying all the relevant interdealer broker product suite across all risk-free rate currency rates. If you're interested in the details, again, your account team or the sales team is very happy to help you and guide you that which rate or which package would be the more suitable for you. On Icons, you can access these free of charge, and on our Datascope Select or real-time for application usage, we will need to consider the necessary licensing fees, as you're probably aware. So let me jump my last slide, actually. One of the challenge as we went through today is really how to compute from the backward-looking risk-free rates, forward-looking interest rates. How to do that in an automated, in a systematic way for all your application and for your processes. How to convert your interest rate and your cross-currency swaps to the new risk-free risk exposures. You can use the brokers, but also on your own what you can do. This has been one of the major challenge, I think, most of the organization. And as listening to our customers and understanding their requirements, we have developed a new risk-free rates, compound rate calculator, and valuation platform, which not only allow you for customize your calculation, but also integrate it seamlessly in your core banking system in an automated and secure delivery way as well. You can adjust the calculations to your requirements and get it delivered via API or a bulk file delivery via FTP into your system after the new risk-free rates have been published. There is one comprehensive dashboard available for you. So across your organization, you can assure that you are using the same data, you are using the same methodology throughout. It's available for all the 10 risk-free rates, which currently is in subject to the change. We can help you with the onboarding, adjusting to your need, and making sure that you have all the support what you need to integrate it into your system. If you have any interest or you would like to have a demo of this solution to better understand how it can serve your daily trading or risk management activities, please don't hesitate to contact your account management team. They will be very happy to walk you through the solution as well. And with that, I would like to move on to the questions. We have several very interesting ones, but before that, and we close it, I would like to remind you our LIBOR resources pages, where we regularly post new information, white papers, analysis, and information which can help you throughout the transition. So I would like to ask you again, please post your questions in the chat. And let's have a look at a couple of them which were available there. So, Jacob, one question to you. How is the new rates transition likely to affect the monetary policies of the central banks in sub-Saharan countries in the near foreseeable future?
Vera, that's a great question. So I think you need to come back to basic monetary policy. So the interest rate should be primarily a function of the level of inflation and the level of growth in the country. What we've got with the IBOR transition is really changing the way that we measure interest rate. So monetary policy should largely be unaffected or not substantially affected by any of the transition.
Thanks very much, Jacob. One for you, Vince. If I enter a financing transaction, say for 5 years, what would be the best option as replacement for LIBOR? Many financiers now talking about a margin percentage to SOFR. Can you please shed light on how to mitigate the risk of SOFR?
Yeah, no, definitely. It's a great question, and I think we kind of covered a little bit with Jacob before, but definitely the answer, as always, really depends on the nature of the financial products, on the currency, and big split between derivatives and cash. As we mentioned before, when it comes to dollar, US dollar, and for cash fallbacks, I would say we mentioned in the slide, if I'm not wrong, different versions of SOFR plus a spread adjustment, right? So I think in the question there is exactly this: a margin, a spread to be added to SOFR. So again, that slide will provide you and will distribute a clear overview on how to solve for the different financial products and for the different currency pairs. But yes, in this case, SOFR plus a spread adjustment. Also, the term rate has got, as Jacob mentioned, wider scope compared to GBP. But again, that slide would summarize the approach. Obviously, we don't advise on this, but it's just what we're witnessing in the market and listening and reading the documentation.
One more question.
Sorry,
yeah, Jacob?
Just to add to that, I was recently talking to a large corporate, and they were really struggling with 2 questions. One of those was, do I do compound SOFR in arrears, or do I do term SOFR? Question for anyone to decide if they feel more comfortable with a forward-looking rate, or do they feel more comfortable with aligning with the derivatives convention? And the other question they were really struggling with what should my spread adjustment be? I think there's obviously proposals that you can add the 5-year median difference. Sounds great, but at the moment, the spread tends to be lower than the 5-year median difference. So I think a lot of firms are trying to look, can I get something which would be more competitive than the 5-year median difference? And if so, what's the fair way to calculate that? So no answers, but that gives you a type of a feel for what other firms are struggling with.
Vince, one more question, and I'm very sure, Jacob, you also can shed some light on it, is regarding, are IR hedging product widely available for term SOFR, and what's the market depth and liquidity? I think we can go back to your slide, Vince, on where is the adoption at the moment.
Yeah, and also that is a good indication. Also in the IBOR app, you would see, which is as I mentioned before, an aggregation of information available for each specific currency pair. You have a view on the financial products being priced from the market, right? So from futures to FRAs and others, and that gives you a nice indication of what is currently being priced and what is available. Definitely, it's growing. Definitely, the role of the broker data and the interdealer broker that Vera mentioned before is crucial there. So
just a couple of slides as Vince referred to the IBOR application via icon. You just need to type IBOR in the search and the view is going to come up. This is the ideal summary for every information which we're collecting and making available for our customer. Here as well, you have available all the regs. We have regulatory documents attached here, and you can also scroll down to the individual currencies with broker data in the back as well. Remaining on the topic in terms of adoption rates, there is another question. Adoption rate of SOFR is around 30%. What is the adoption rate for term SOFR compared to overnight SOFR? Anything we can share with that?
So maybe a few thoughts from my side. So when we say SOFR adoption is around 30%, it's really important those stats relate to linear derivatives. So it's not possible to say SOFR adoption in the aggregate across all financial markets. You're very much just looking at an example of a product, a key product. You're not going to see term SOFR being adopted in the linear derivatives market. That's not what it's designed for. It's designed for primarily use in cash markets and some very limited hedging. So if you were to measure it against interest rate derivatives, you're going to end up with something very close to 0%. Where it's designed to be used, which is in cash products, it's a little bit more tricky, or particularly a lot more tricky. A lot of the times it's used, for example, in loans, and loans are publicly reported. I think the initial stats are it's got a strong amount of adoption so far. So term SOFR is widely used. I think the stats provide hundreds of clients who are using the rate, but getting access to information which is accurate on the proportion of cash markets is pretty tricky.
Thanks very much, Jacob. So let me take one question. What is the difference between data available on Bloomberg and data available by Refinitiv? And is the use of data published by Refinitiv free? How does this work? So let me just go to generally look into all the data, what we are carrying, as I said, available via the different data feeds for application and server usage. When it comes to data usage, generally, with most data provider is the same methodology. If you're using it on an individual basis, if you're using it on your desktop for your own decision-making process, then most of the cases this is free of charge. Some of the benchmarks, some of the fixings, they may be there is an individual end user fee to accessing them real time, but it always needs to be looked at one by one cases. However, when you are using and consuming the data for an enterprise purpose, which would mean for processes which is supporting for your whole organization, being it front office processing, be it if mid office processes, risk management or limit management or trading or back office, for that matter of fact, that usually this data is subject of data licensing. Having said that, at the moment, due to the adoption phase at the beginning, not all of the data have that fee adjusted to that. So I would recommend that you reach out to your account team and they will guide you through that, which part of the data is available free of charge via feed usage and which would be a subject of fee liability. Regarding the other part of the questions, that what is the difference available in Bloomberg and what is available in Refinitiv? Some of the data, for example, the risk-free rates are regulatory rates. So obviously, that's all data provider will be making available exactly the same rates. Our uniqueness is that we are owning and calculating Refinitiv term SONIA, which at the moment only available via Refinitiv desktop icon product as well as the data feeds, which has a very high adoption rate across all markets globally. And as we go forward, we really try to add all data which is available to our data feeds. But as I said, most of this data is regulatory recommendations, so most of the data vendors will be carrying. What is unique next, however, I believe that we are working with the inter-dealer brokers very closely, and they onboard many data sets which are unique for Refinitiv, and you will not find at any other data providers. Why to use the broker data? As I mentioned during my slides, on one side of it is that some of the data which we usually got from contributors like IRS curves, OIS curves, cross-currency basis swap curves, at the moment are not available from the contributors, yes, because the adoption is at not that level. And at the moment, only the brokers are the ones who are having the necessary level of deals where they can actively price these instruments and share it. So with that, we have a couple of more questions. What about, I wanted to understand the rationale in the credit adjustment performed by lenders and what level of subjectivity to account for, and especially if we have in place IRS based on LIBOR to convert it with the LIBOR transition. I don't know, Jacob wins.
Well, definitely not an easy one to tackle with, to deal with, but there is a level of, subjectivity, right, in the application of those. I don't know if you have any. I don't have a specific view on that on myself.
Yeah, I think you could obviously try and have some objectivity calculated based on some sort of rationale. The convention, which is widely adopted for fallback rates, being cash or derivatives products, is based on the 5-year median difference. That's great as a long-term average. It's not quite so good in terms of reflecting short-term averages. For the cash fallbacks, we've seen the 1-year transition period to help manage that adjustment for the consumer products. But I think ultimately from the lender's perspective, it's a discussion with the borrower trying to identify something which represents a reasonable compromise. I think at the moment, because the spreads are low in the 5-year median difference, they tend to be based on, again, a lower number. But it's really at the discretion of you and the borrower come to agreement on a sensible approach. I'm not sure there's a one-size-fits-all answer.
Thanks very much, Jacob. We are at the top of the hour, so we really would like to thank you that you spent the last 1 hour with us. I hope that we could help you, guide you in this process. If you have any more questions, please contact us. Several times I already mentioned. I know I'm getting there, repeating myself. Contact your account team and they will guide you further in terms of the data sets available. You can have access to our LIBOR key dataset Excel file. And if you are an Icon user, and I hope many of you are, please just type IBOR in your search and you will get our IBOR app opened, where all this information also summarized for you. So with that, thanks very much for you, and I wish you a lovely day.
Thank you very much.
Thank you.
Thank you. Bye-bye.